The views and opinions of this program are those of the host, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Today's episode of Market Talk is brought to you by Growmark FS. Keeping up with the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic, grain, and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. Well, the Federal Reserve came out on Wednesday and said they're leaving interest rates alone this month, but they indicated there could be more rate hikes later in the year. And that is something that traders were waiting for and watching to see what would happen as we work through Wednesday's session, also watching the weather and much more. We're going to dive into what's happening in the market trade today. Joining us, our good friend Mike Zuzolo with Global Commodity Analytics. Mike, thanks for being with us here. And, we were chatting a little bit before we went on the air. Waiting on Fed news on a Wednesday is always an interesting day. No interest rate change, but if you look deeper to what the Fed had to say, seeing them talking more rate hikes later in the year, so it feels like kind of a mixed bag in my mind. How would traders really interpret this? What's your take on it?
Yeah, I think you're right. Early on here with Jay Powell now starting to talk as we tape this, Jesse, I think it's really important to just focus right now the attention on the benchmark lending rate, that median number. The Fed governors prior to this announcement today and this update today had a 5 to 5.25% benchmark. They're now looking at 5.5 to 5.75 by the end of the year. So they tacked on another half percentage point as I see it. The trade, I don't think, was ready for that. The equities markets are taking a nosedive at this point, and the crude oil market is also deeper in the red with the dollar coming back from new monthly lows before the Federal Reserve update. And so I think the trade was expecting a pause. They got the pause, but I don't think they were expecting the Fed to really hammer the benchmark that much higher, a full half percentage point with only 6 months left now in the calendar year. And that can be a real issue because the early comments from Jay Powell as he started his press conference before we went on together was he acknowledged the full effects of the rate hikes are not in the economy yet. And so this is going to be another one of those factors, I think, we're going to have to dub back and push back into the market. Are we on our way to a recession here in the United States led by the Federal Reserve?
Well, one thing I know you're watching, I'm going to pull this chart up on the video feed, and I want to talk about this. You're looking at 10-year treasuries, and this is tied into the interest rate talk and more in the broader economy. But I know you mentioned to me this is one of your indicators as to whether or not we could find a chance to rally this grain market potentially here at all. So can you talk about that thought and walk us through this chart a little bit, Mike?
Yeah, I thank you for that setup because we did have earlier this week the Chinese government come out and say, we admit it, we're not doing well. Our zero COVID policies slowed us down. We're not coming around as fast as we want. And we had fresh multi-month lows against the offshore yuan until the Chinese People's Bank of China came in and actually started injecting liquidity back into their economy like they typically do when they're slowing down too quickly. And so I think there is a better shot than 50-50 odds going into this Federal Reserve report and update that the commodity indexes, the commodity funds may start to look better and more agreeable and favorable upon the emerging markets and therefore the emerging market currencies. It's not a coincidence that the Brazilian currency made a fresh 1-year high against the US dollar this week after that Chinese announcement. But now we have the Federal Reserve and the US dollar playing a role again. It's not just about China and their economic recovery. And that's why this chart comes into picture and into focus so much more. Notice this is the actual Treasury on the 10-year benchmark, Jesse. This is not the yield. This is the actual futures. Yields and futures move opposite one another. So we're near the low on these futures markets. We're actually getting back in towards the areas of the old lows that we carved out, kind of a double bottom. We have not been able to take out the resistance. And as you say, we're forming a wedge, and we're forming a wedge. And my eyeball goes to the very far left of this chart back in the 2006, 2007 timeframe. Is the trade now after today going to take this wedge and break it to the downside and complete kind of a cycle all the way back down to the 2006, 2007 double bottom, because we're going to see rate hikes again in July, August, Sep. I think that's a better than 50-50 odds. So essentially what I'm fearful of is the Fed today kind of erased what the Chinese economy, or what the Chinese central bank did earlier this week. So this breakout of this wedge is really paramount in my bigger picture. Can commodity funds come in and buy commodities on the idea that they're overdone to the downside?
Well, and the other side of what you were talking with me about before we went on the air was something that you and I have been talking about for quite some time, is the wheat market being the leader to the upside. So tie that in with what your thoughts are with the 10-year treasuries. Obviously, this wheat market, U.S. wheat is more expensive than around the rest of the world. I think that cheap Russian wheat and more. This wheat market, if we want it to be the upside leader, it's not doing a very good job here as of late, Mike.
No, and you can see that in this week's trade. And the European wheat that you and I have featured quite a few times, I'm cutting back on that chart just because it's getting more and more expensive to create from licensing. But for clients and subscribers, I send it out pretty frequently. But that chart tested the long-term resistance drawn off the May of last year high, and so far it's failed. And that's even with the news that the French crop's getting hit by the drought, the Baltic is getting hit by a drought, and also that the Russians were looking maybe at coming out of the grain deal early. That last thing has since been diffused by one of the key guys that talks all the time and is a mouthpiece for the Kremlin. He's saying they will not leave it early, but it's unlikely they will come back in and extend it. Well, the trade thought, well, they've said that 3 times now and they've extended it, so let's take the wheat back down. And it was right when we were testing that essentially $7 a bushel equivalent in the Paris wheat futures.
Well, I know in the case of the wheat market too, here in the U.S., spring wheat, you think about the Northern Plains, crop looking okay, but then the Canadian prairies pretty dry. Sounds like they could get some rain here, but I know spring wheat compared to KC and Chicago wheat has held up a little bit better as of late, but still not great, Mike.
No, I think that's a great way to classify, because we only have good to excellent conditions 6% better than it was a year ago. And last year in the plains, it was a train wreck. And so it's not far from a train wreck in terms of conditions based upon only being 6 points better. And I think you're right. It's held its own, but it has not put any kind of premium in the market because of the other classes. And I think this goes back to the soft red wheat as well as in that European market connection in those imports that you were talking about. But it also goes back to the fact that we are really getting delayed on hard red wheat. I was hearing from a couple different sources that we'd start cutting wheat on the Oklahoma-Kansas border as early as the 1st of next week. Well, models are saying 1.5, 2 inches of rain in that area that they'd be cutting. So it looks like we're going to have to go through another week of really very little being done. I actually did a radio program earlier today with K-Buff, which is closer to that Hutchinson, southern Kansas, southwest Kansas area. One guy I talked to had 9 inches of rain in the last 2 weeks. And so I can't imagine how long it's going to be for some of this wheat cutting to take place. And I think the market just considers that as, well, that just prolongs it, and therefore let's go ahead and let gravity take effect. So we really need a catalyst in the wheat market to help support this row crop weather market.
Well, and I'll just pull this up real quick. I'll use this from my good friend Eric Snodgrass. We showed this earlier this week. This was last week's drought monitor, and on the video feed you could see some of those areas of deep reds in Kansas, there, Oklahoma, Texas. I have to think the new monitor here this coming Thursday should it be showing an improvement there, Mike, and maybe not so much in the heart of the Corn Belt though. And I think that's where we should shift our conversation to talk corn and soybeans, because we're definitely in the throes of a weather market right now. And I know both corn and beans have tested some moving averages here in the last 24 hours. And I want to talk about that. But obviously just the weather trade overall, traders try to get a handle on this. And I think some are putting stock in the forecast and trading every single one, and some not putting so much faith in some of these forecasts right now.
I agree. And I think the key this year that it makes it a little bit more simple for the producer out there and for the analyst, I think, Jesse, is the trade is all in on the crop conditions. One of the few years that I can see that the crop conditions are really hitting the prices. And I think the question now on Wednesday afternoon, we kind of flew around the airport on Wednesday in a pattern, waiting to land and decide what we were going to do here towards the end of the week. Again, because like you're talking about the models, and I'd also say because of the Fed. But now the question becomes in the trade's mind, just like you were talking about in the drought monitor, what do next week's crop conditions look like? This week we had 3 states under 50% good to excellent in corn. Illinois was the big one that was underneath it. We had 0 last year at this time. The trade is very well tuned into that. I did a little bit of analysis on the 12 biggest states I look at for corn, and the average good to excellent is down. When you add up all those states and then average them, we're down about 13.5 points in good to excellent conditions for those 12 states. So it really begs the question, when last year's yield in the country was 173.3 and this year's at 181.5, I think many of us in the trade are starting to take that 181.5 off the table. Clients and producers from Kentucky to South Central Nebraska are all telling me almost uniformly that they will lose a sizable chunk of their crop in corn this coming weekend if they miss the rains again and this temperatures start to warm up. So I think a sub 180 trade is already starting to develop in this market. I think we could start talking about 175 a week or 10 days from now if this pattern doesn't shift.
Well, we are having a conversation here today with Mike Zuzolo of Global Commodity Analytics. I want to stay on corn and soybeans a little bit more here with you, Mike. I'm going to pull up on the video feed the December corn daily chart. And I mentioned this earlier. It looked like we've tested some moving averages in both corn and beans here the last couple of days. So walk me through what you're seeing in these corn futures here right now.
Yeah, one of the more reliable formations in the grain markets, it's not every market, but in the grain markets, in my experience, has been a head and shoulders, where you essentially have a low and then a lower low and then a third low that kind of looks like an upside down shoulder. And that's what this chart shows by those purple squares. You've got the left shoulder, the head is the major low, and then the right shoulder. We've broken above what you would call the neckline. And so you have a technical breakout. You've gotten back up above, I think, the July of last year's lows of 542.75. And notice what we did. As you say, we tested the moving average. That test of the moving average also came in the later part of the day yesterday on Tuesday, when all of a sudden the EPA started talking about pushing out their blending final rule on their biofuel mandate. I think that probably caused some fear by the longs to get out of the market and take some profit off the table, especially with the models not showing completely dry weather in Iowa and parts of Illinois. So we tested this, long-term moving average in blue. Now we have also tested the uptrending support line. That's the dotted line there. And that's really key, because now we're going into the end of the week. It's kind of flip or fly at this point, technically speaking. Either we hold and we go above that 200-day moving average on a closing basis, and we open up to the dotted white resistance line, which is sitting up there around 590, or we break down. And I think it gets about as simple as that in this short-term weather market.
Same question in soybeans. I'll pull up another chart on the video feed looking at November 23 beans. I know we've tested some moving averages there. What are you seeing with the formations on this chart, Mike?
Similar pattern on the head and shoulders low, which I've got in the white squares. It's pretty hard to read, and we've been able to get back up above those July lows of around 1247, I think it was. But notice that we've already now tested the white downtrend line, and the 200-day moving average is actually quite a bit above. So kind of the opposite of the type of technical resistance we're facing. But my bottom line point would be, there is a support line I didn't draw on here that's quite a bit ways below this market. If we can go above that white resistance line, then that should and could, I think, technically speaking, because of the way the funds tend to trade, open us up to the upside of that 1280, 1285 level where that 200-day moving average is. But what I love about these charts is how similar they looked when they put in these what I call inverse head and shoulders charts. And The godfather of technical analysis is John Murphy. Used to be on CNBC. Has a great technical analysis book that's still in print if anybody wants to look more into that.
I want to make sure we talk about livestock here today as well, Mike. And I'm going to pull up one more chart on our video feed, the weekly feeder chart. I got to ask you, though, and we can tie it in with this chart. Wednesday's trade action in both fats and feeders was a little discouraging. Should we be worried with some of the way the trade action we saw on Wednesday in cattle?
I think we should, because what you see from essentially the early part of 2021 all the way till this last 3-4 weeks of trade is a pretty steady gain, and that's what you want in a market. Then we had what I thought, would be a blow off top. We had talked about this last week. It was, I think, going to be a blow off top. It looks like it is now because we made new weekly lows today on Wednesday. Last week's prior low was 236.83. We closed below that. Now all we have left for support is that top from that big bar higher, about $1 below us. So we just can't go below that on a closing basis, because then if you look down at those stochastics, Jesse, they're getting ready to turn and give a sell signal with that green line getting ready to go through the purple line. If you lose both the chart support from that old high and you go into a sell signal on a weekly basis, that's going to be tough for the technicians, especially as long as the funds are to contend with. I'm less concerned about the fat cattle market because you're down at 177, 178. Cash is probably going to come in and shake out somewhere in the next 5 days. Buying for July 4th coming in probably around 180 again, maybe a little better. And so you don't have any kind of premium in that fat cattle market, but the feeders don't look nearly as good fundamentally with the corn market, nor do they look as good technically on this weekly chart.
Well, and thinking too with the Fed news, obviously we're still watching the economy, watching the retail case. When could some of that demand for beef at the retail counter dry up? I know it's summer grilling season, but obviously there's a lot tied in. And as to your point, I'll circle back to earlier in the show, how there's that thought out there from the Fed that the recessionary items have not fully hit the economy yet. So I think that's something to tie in with cattle as well here, Mike.
I agree. And the 80% ground beef, to your point, has shot back up again. It was leveling off. That was making me feel a little bit better about the summer grilling season. But you're right. We got to think about the funds and how they trade. And they oftentimes go above and below fundamental value levels. And they do that a lot to us. So don't think the feeders can't go down. Don't think the fats can't go down. I've been talking about hedges, haven't pulled triggers, but now it's time to really move it if we can't pull this thing back together at the end of the week.
And that hog market on the flip side, a solid day Wednesday. I know June going off the board, close to that index. Now July is going to take over as lead month. It's got a few dollar premium to the cash index. But, hogs, hey, so far so good. It's been since we kind of maybe found a bottom here a few weeks ago.
Yeah, that's the best thing going for the cattle right now is the hog market coming around, especially with that cattle hog spread getting upwards of $100 premium to the fat cattle. We may just be unwinding that spread right now. That's what I'm hoping. But I think the key now is with the June off is to see that consumer continues to come in, as you said. Pork continues to win the day when it comes to the retail side of the equation. So it should. And so I think we are steady as she goes with the hogs. I'm hoping they come in and support the cattle. And I think that, lines us up with the weekly export sales coming out Thursday morning as being a pretty crucial part of the puzzle.
Well, Mike, tie all this up for us here today. I know there's a lot going on in the marketplace. We have to keep our eyes on. Final thoughts, anything else you want to mention or reiterate for folks here today?
Yeah, bottom lining it out here, this year is just like last year after the January time period. It's about weather, it's about supply. It's still a selling type of market unless you're a feed buyer, Jesse. It's a hedging type of market because we don't have that demand underneath us. And I want to see what the Fed does in the market reaction to it. But I'm not as pleased with the Fed, and so I'm not as eager to jump in and buy these grains until I see demand come back in.
Well, Mike, if folks want to reach out to you, get some advice, take a look at your analysis, what's the best way to reach you?
Best way is to call me, 866-471-2588, or go to globalcomresearch.com and sign up for a 2-week free trial.
Globalcom with 2 M's, globalcomresearch.com. With that, Mike Zuzolo, Global Commodity Analytics. Always great to catch up with you, sir. Thanks for the insight. Have an awesome week. We'll talk to you next week.
Thanks, Jesse, and appreciate you having me, sir.
That's going to do it for the show today. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.